Are you self-employed and you went to the bank and you were declined on a mortgage because the bank said they looked at your taxes and said you don't make enough money? Well, this is the catch-22 with self-employed people. The government says, go ahead, start a business. You're going to create jobs. And in doing so, we'll give you some deductions and write-offs you can take for the business, and that'll keep the business afloat. Well, this is all well and good, but when you do your taxes, because of these write-offs and deductions, it may show that you made very little money. Sometimes you lost money. And that's why banks and credit unions are declining you. Well, have no fear. There are programs out there, and one of them is called the Bank Statement Program. And what we do is we take 12 months or 24 months of your bank statement and we average out the deposits from your business going into those accounts or that account. And whatever the average is, typically we take 50%, and that would be the gross income that I use to pre-approve you for a loan. So, for example, let's say you average $10,000 a month. Half of that would be 5,000. So that's your gross income. Pretty simple. So that's the general formula. Now, I will say a couple things. It needs to be one account. It can be a business account. It could be your personal account, but you can't have multiple accounts. They don't want to commingle, stuff like that. The other thing is you need to be in business for 2 years. Okay, so the lenders want to make sure self-employed is risky as it is, but the lenders want to make sure that at least we have 2 years of history under our belt. Okay. A few other things about these loans. They do carry a higher interest rate than what you see advertised as conventional. Reason being is the lenders feel that these are a little riskier because it's self-employed as opposed to someone working for corporate America with that steady income coming in. And so it could be 1, 2, maybe as much as 3 percentage points higher than conventional. The other thing is your down payment, 20%, I would say, would be a good rule of thumb. You might see some out there at 15% or 10%, but the bigger the down payment, the better your interest rate. Okay. And the other factor would be your credit score. High 600s you need to be in, preferably in the 700s. But again, these loans, your credit score and your down payment have a lot more bearing on the interest rate that you'll receive. Okay, so keep that in mind. A few other things. It is fixed rate, not adjustable. And this is for primary house and secondary, not investment properties. Okay, so hopefully that gives you a good feel for these bank statement program loans. And if you have any questions, just feel free to hit me up. I'd be more than happy to help out and hopefully get you pre-approved and get you that loan. All right, have a great day.